everybody. Let's get started. Um, so for this week's forum is going to be again at Mendocino Hall 1005, Research Across the Globe in French and English, Delane Russell. Now, this week, we're not going to start with our recap as we normally do, because we're going to sort of roll everything together of the investment pieces at the end. So we're going to do a nice big recap of a lot of stuff that we went through at the end of today's class. But today we're going to start talking about risk tolerance and investment objectives and sort of calibrating a little bit to make sure that you're in line with where you should be with your investments. I like to put this towards the end. A lot of times people will put this conversation at the beginning, but it's difficult to sort of think about what risk tolerance even really means when you don't know what the investments, how they work, or how they're supposed to function in your portfolio. So I like putting this at the tail end of this discussion to make it a little bit easier for us to understand, because we already have some previous knowledge about the vehicles and the tools that we use for determining this. So one of the things that is one of our handouts is from Charles Schwab. They actually have this nice little risk tolerance worksheet that you can go through, and it gives you a number. So if you don't feel confident determining it for yourself, going through this and getting yourself a risk number and getting a risk tolerance can be very helpful and get you on the right track. And then we've got our own handout sort of discussing a lot about that. But when we talk about risk tolerance and objectives, obviously I'm speaking from the perspective of the professional, from the perspective of the advisor. So advisors and investment firms will typically use standardized terms to refer to general asset allocations and investment purposes. It's pretty common across all the different firms what these terms mean for the most part, even if their allocations differ slightly. So your advisor, if you have one, has probably assigned you to one of a few categories. But they may or may not have talked about like what it means for you. You might just know that you're in a balanced portfolio or in a growth portfolio, but you may not really know what that means. So knowing the category of investor that you fit into makes portfolio building or choosing from pre-made models or other pre-built solutions, it makes it much easier, because it's really easy to just align yourself with a certain level of risk and a certain allocation of equities and fixed income and the like. So there's two key things that go into determining what investments you're going to use, and they're called objective and risk tolerance. They can be somewhat similar, but they do have some differences. So the objective is typically going to be what the actual purpose of the funds invested are. What are we trying to accomplish? Usually this will describe what types of investments go inside, what types of asset classes are used. So you might have something like a maximum growth portfolio that's pretty much all equities and tech funds or growth funds or whatever the firm decides is going to be the largest possible growth portfolio, versus a current income portfolio is something that usually is going to have a mix of investments that distribute income for you to use as an income source without pulling from the principal. Things like bonds or dividend stocks or preferred stocks or the like. Risk tolerance is closer to an emotional sort of measurement. It's the amount of volatility that an investor is comfortable experiencing. So there is some sort of numeric component to this. There's an amount of risk that you can take without, having your probability of success drop by a lot. But then there's the more important thing, for me at least, which is the amount of volatility that you're willing to sustain and still stay the course and not change things. So it's more of like at what point, what sort of drop can you experience and still stay the course? It's important, like I mentioned, it's also important to consider the amount of risk that you're able to withstand. So there might be, a certain point where if your portfolio is super volatile and it drops by 50%, if you're needing to take income out of that, that can sort of change the future of things. As if you have a big drop and then you're still taking the same amount of income, the same amount of distributions out of that, it reduces the amount that's invested back into the market to grow, and it could handicap sort of the future possibility of that portfolio being sustainable. Now, here's what pretty much we describe as our investment objectives. When I'm looking at a portfolio, when I'm looking at what we're trying to do, I usually pick one of these four things. These are kind of how I normally go about things. Usually when I'm building an investment portfolio, it's going to be limited to these three. The capital preservation is really just something else there that really is mostly focused on things like generating interest or maybe getting the best out of a high yield savings account or super short-term bonds. But essentially, what capital preservation means is all the investor wants to do is preserve the existing value. They just don't want to lose value, which can be an objective if you have enough capital or you just don't want to lose it, or you're using it in a short period of time. If you're going to use all of that capital in a short period of time, in a couple of years, you probably don't want to be taking very much risk at all, because we need, like we mentioned before, extra time for that extra risk to pay off. Now, current income generally means that the investment objective seeks investments with an emphasis on income generation. This can also just mean a sort of lower tier of risk, as income producing securities tend to be less volatile generally. They may like to have some exposure to equities, but they're mostly concerned with preservation of capital and generation of income. Now, you'll probably usually have at least some healthy exposure to equities to continue the growth, and also to potentially have dividend stocks and the like in there. Now, balanced is where most people are going to fall. This investment objective means that the investor seeks investments that are generally allocated among holdings that generate income, as well as those that which offer the potential for growth, such as stock and stock funds. So the investor should understand that many stocks and stock funds have an income component and are willing to utilize them to generate income. So really what this is just saying is we're trying to get a little bit of most of the pieces. We want some fixed income in there. We want some dividend heavy stocks. We want some growth stocks. We want some super short-term treasury bills, all the different stuff. This is really where you're just going to get sort of the most diverse, the most, overarching sort of portfolio. Then obviously, as we move to growth, the whole point of this sort of portfolio is to grow it over time. When you're in the accumulation phase or you're not taking distributions, for the most part, this is where you're going to be, because if you don't have a need for risk to be low, then you can take extra risk and allow that time to pay off. Also is helpful for beneficiary accounts and such. Yes.
Would growth be appropriate? Would growth be appropriate, like when you were setting up a college fund for
Yeah, so
infant?
absolutely. So if it's a fresh account and you still have those 18 or 20 years, absolutely. Growth is where you want to start, because you want to give them the best chance of having enough capital to pay for it. And sort of as you get closer, you slowly sort of, pull that equity amount down and start adding in some more stable stuff.
Is there a age parameter when growth becomes not such a good idea, or does it depend on the person?
I think one, it depends on the person. It depends on the amount that's going in, right? So if we need a higher level of return to get there from a smaller amount of money, then you might need to be more aggressively invested in order to get there, especially if you have the time. But you could probably, if we're changing between these three things, you could probably just break that time period up into thirds, like if you move from growth, and then in 6 years you could move down to balanced, and then in another 6 you could move to current income. And then when we get to the point where we're going to start spending, you move all the way down to capital preservation. That would be an easy way to think about it, I think. So the next piece is risk tolerance. So different firms can have different models, but we're going to show you how we think about it for our demonstration purposes. There's a lot of different ways that this can be calculated. There's different ways that this can be represented when it comes to choosing portfolios. But the one that I'm most familiar with is the stuff that we use within our office. So I'm going to talk about it from that perspective. So risk tolerance is generally scored on a numeric basis, dependent on your answers to some common questions. That's why we gave out a handout with the questions for you to answer that can possibly give you that number. So this number score correlates with a particular risk level of a given portfolio, which is basically generated by combining a bunch of different broad asset classes into a theoretical portfolio, and then looking at its standard deviation, which is pretty much just translated right into a risk score. So any risk score is pretty much just talking about standard deviation when it comes to an example portfolio. So a higher risk score is going to mean a higher standard deviation. A lower risk score is going to mean a lower standard deviation. When an advisor recommends a particular portfolio, whether it's managed in-house or by what's called a separate account manager, which is when they have another a different firm like a BlackRock or a Vanguard or a JP Morgan do the portfolio for them, they'll be matching your risk number to that of the portfolio that they're picking. So whatever risk number you generate basically just lets them know, okay, now I just need to match to a portfolio that reflects that same risk number. Our portfolio solutions and client risk tolerances are graded on a 5-point scale. So you'll see that this kind of like blends together both the objectives and the risk tolerance into one thing. So we're going from capital preservation to conservative to moderate to growth to aggressive growth. And that's sort of how that risk is calculated. It's just pretty much the lowest standard deviation all the way to the highest based on different types of theoretical portfolios. So again, when it comes to capital preservation for risk tolerance, we're tolerating very little market fluctuation, and we care way more about maintaining the initial investment amount. We're not looking to lose principal. We want to maintain it and maybe just earn a little bit of interest for our time. When we get to conservative, we tolerate a little bit more risk, but we're still averse to large short-term fluctuations. We're still looking for something where maybe we have 10 or 20% in the stock market, but for the most part, we want to keep most of our money safe, while maybe a little bit is expected to grow in the long term, but we want to maintain the majority of our assets in a safe haven place. Moderate is your middle of the road category. You desire a little bit of capital appreciation. You're aware that some risk will need to be taken on, but you hold a wide range of asset classes to diversify and maybe temper some of that risk. Growth is a person who desires a portfolio to appreciate in tandem with the stock market indices. This is a kind of person who is invested probably 70, 80, or 90% possibly in stock market funds. Depending, it could be growth focused or it could be dividend focused, but they expect that when the market indices, the S&P and NASDAQ go up and down, that their portfolio is going to move in a similar way. Now, a person who's in aggressive growth, they desire their portfolio to appreciate substantially with the stock market. Potentially, they want to try and do things that look to outperform, but there's no guarantee of that, obviously. And they accept a very strong drawdown when the markets fall. So it's just, if you see S&P and NASDAQ going down by a lot, you understand that you're probably going to be with them or in more of a drawdown than those indices. So here's a couple example portfolios that we can look at. We're just going to do a little practice of matching things together. What we're going to use are these example portfolios that are built with 2 ETFs that are we're just using those to sort of use a hypothetical portfolio. We're just using the S&P 500 and an ETF that picks up all the bonds, which is called the bond aggregate. So just all of the corporate and government and all of the different types of bonds that we could use. And we're just allocating a certain amount to the S&P 500 and a certain amount to the bond aggregate to give us our different portfolios. Obviously, you could have a lower risk portfolio than this one that's in 100% of the bond aggregate if you decided to go in all treasury bills or something. But again, it's just demonstration purposes where equities are risk on, bonds are risk off. That's all we're thinking about. So we're going to look at a couple examples of investor profiles and how we might match them to those portfolios. So this investor is retired, currently retired, and he's got a pension that pays for roughly 70% of their expenses. Distributions from retirement accounts pay for the remainder, plus a little bit of entertainment and travel. Got to have a little bit of fun. So this investor desires to have some assets left over upon their death for their beneficiaries. So we're not looking to exhaust the entire account by the time we get to passing. We want to have some left over. We've got a risk tolerance of moderately conservative. This is a person who's already, finished accumulating assets. They're not looking to add anything more, so they want to have a little bit less of a risk tolerance. And their objective is balanced because there's some income generation that needs to happen. There's some distributions that need to happen, but there's also an expectation that assets will be left over. So we will need to grow the assets further as time goes forward. So currently, there's persons invested in 100% stocks. No bonds, their beta is 1, so they have the same risk as the S&P 500, and the standard deviation is sitting at roughly 15%, maybe 16%. So the question is this a good match? No, probably not. We're probably a little bit more aggressive than we need to be, considering a moderately conservative risk tolerance and a balanced objective. So the thought would be, where do we think we would position? Now, keep in mind, there can be more than one right answer, but I would be curious, which one of these would one of you pick? Any ideas?
40-60 or 60-40.
Okay, yeah. I would say that's pretty much where I would be as well. Depending on how this person, answers those questions and what kind of risk score we determine, a 40-60 and a 60-40 are the perfectly healthy choices. Those are exactly where I would be. And basically just think, maybe propose both of those portfolios and see which one feels better for that client. So this person, if we did choose that 60-40 portfolio, our beta is more like 65%, roughly 65% risk of the S&P 500. Our standard deviation drops just under 10%. And the primary objective is growth because most of those expenses are paid for, right? We're only supplementing a small amount with a secondary objective of income. So if we knew that much more expenses were needed to be drawn out of the account, maybe we would shift more conservatively so that there's more assets available for that. But knowing that most of the expenses are covered, and really the thought is we want to maintain the account balance and have just a leftover amount for beneficiaries, we're more comfortable in slightly more stocks than bonds. So can we make the recommended portfolio more suitable? Well, yes, of course we can. If the account is large enough for the income needs, we could consider a more conservative allocation. We didn't talk at all about account balances, how much money is coming out, and all of that's important as part of what we're using to determine the portfolio. If you've got an account that's bigger than what you really need, you can go more conservative because the amount that's coming out is going to be relatively smaller. It's going to be a proportionally less amount. So you could take less risk and not have to worry about increasing the size of the account, or you could take more risk because you know that there's a bigger initial balance. It really just kind of depends on what's comfortable with the investor. So next up, we've got an investor that's in college. Their parents are paying for their tuition, so they have no cost for that. And they have a Roth IRA that they contributed to money with their fast food job. So they're just tucking a little bit aside. They don't really have much in the way of expenses, and they're investing their money for their retirement in an account that they can't access until they become 59 and a half, or at least for their earnings. So she's got a risk tolerance of aggressive and an objective of growth, because clearly we're pushing out the need for these assets to a much later future date, probably more like 40 to 50 to 60 years from this point. So clearly, we don't need to be worried about distributions from this account. We're not pulling assets from here to pay for things. So she's sitting on a portfolio of 60-40. Maybe she heard that that was a really good portfolio to pick, and she just went along with that, and that's what she's got. Her beta is at 0.65. Standard deviation is a little under 10%. Now that's okay. It's not a bad portfolio. We're not saying that this is the most horrible thing that she could be doing, but I mean, what do we think we would pick in this circumstance? If we've got so many decades ahead of us that we can sit through all of that volatility, we can sit through that volatility of the stock market and the growth of the stock market, what kind of portfolio will we pick for this person? 80-20 or 100-0? I would go for that 100-0 because again, there's no distributions coming out of it. If there was any thought at all that she would be pulling money from this account, yeah, I would add a little bit of bonds, or maybe in a circumstance where the stock market is so incredibly extended that we think the valuations are ridiculous, maybe you can throw in a little bit of bonds for some buying opportunities later. This portfolio, like we know before, has a beta of the stock market, standard deviation about 16%. And again, that objective is growth or maximum growth. And the investor's not expecting to utilize the funds for at least a few decades. And if you have at least a few decades, if you can recall back to, I believe it was a Morningstar slide that we showed, it was the reduction of risk over time frames, where 1 year it was really strong risk for the stock market, 5 years it was reduced substantially, 10 years it was reduced even more. So as we have more and more time for these investments to grow, the risk of being all in stocks actually reduces over time because there's just such a higher probability that will end at a higher value in comparison to the short term. And now obviously we're going to have a little bit of a caveat that is provided they have adequate emergency funds and health insurance, then this portfolio is great. But if we don't have that, we might need to include that consideration in our portfolio, because if there's no other funds to pay for the deductibles, there's no funds to pay for emergency expenses, we might need to consider that within here. So now we're on to our next investor example. So this person is currently looking to purchase a new home, and they've saved $100,000 as the down payment on the mortgage. So they expect to find and close on a house in the next year. Very important. And they've deposited the cash into a brokerage account for the time being. They just want to put some stuff aside. They want to maybe earn a little bit of interest while we're waiting. So we put it down. We can maybe grow our money by just a little bit before we go and make the purchase. So we've got a risk tolerance of conservative and an objective of capital preservation. We want to make sure that we keep this $100,000 so that we have the same purchasing power when we go to buy that house. Because if we have a big market downturn and now suddenly we have 60% of the money, well, now you can't afford the same house, and that's a big problem. So currently, this person's invested in a 20% stocks, 80% bonds portfolio. The beta is maybe 30% of the S&P. Standard deviation is roughly 5.32%. Now, this is a conservative portfolio, but I want to remind you that we're looking at expenses in approximately 1 year. That's a very short time frame. So even if we have a low standard deviation, even if historically this portfolio is going to be pretty conservative, we still have to understand that this could affect our purchasing power. A 50% decrease in the stock market would effectively reduce the purchasing power by 10% and drag $100,000 to $90,000. That's important to consider. So if we're looking at that, I mean, I hope we all are on the same page about what the answer is, but what portfolio do you think we'd pick for something like this? I'm going to say 100% bonds. Obviously, in this circumstance, 100% aggregate bond fund may not be the most appropriate thing, but for our demonstration examples, we choose something like this that has a very low beta, a very low standard deviation. And the reason for this is because of how short that time horizon is. Because it's just a year, that's why we want to go the lowest risk possible. No worries. So, oh, yeah, we got a call in. So again, could we make that recommended portfolio more suitable? Well, yes, we can, because we can focus on ultra short-term government securities instead of a bond aggregate portfolio. Like I've showed before a couple times, when you pull up those bond aggregate funds, they can be pretty, they can have a bit of risk associated with interest rates. If interest rates begin to rise, the value of those funds can get dragged down pretty substantially. Versus things like money market funds, ultra short-term government securities, those are not going to move quite nearly as much. Treasury bills, money market funds would be the most suitable for something like this. So here's a couple factors that could impact our objectives and risk tolerance. If there's a substantial change in assets, time horizon, or cash needs, it's likely that our objectives and risk tolerance would change too. So it's important to know that if any of these changes happen, you have to look back on that investment account and think about, does it still fit within what my circumstance is? All of these factors directly impact the objective by changing the scope of the investment strategy. More time means more acceptable risk. Greater cash needs require more stability. It's the same things that we talk about over and over again, but we just have to now remember that as we're sitting on our portfolio, if something in our life changes, we need to make sure that our portfolio reflects that. So an example of that is a sudden cash need. If we're looking at a 60-40 portfolio, but 20% of the portfolio now needs to be liquidated in the next year, we know that we need to take a big, giant piece of that portfolio out because maybe we had a big disaster and we need some emergency cash. Liquidating half of the current bond allocation would now kick that portfolio into a higher risk profile because we have less bonds. So in order to be proactive about this, we would want to decrease both the equity and the bond allocations at the same time in the same proportions as the 60-40 in order to increase our cash allocation to push that out of the portfolio so that when we distribute that, we're back to our 60-40 and we're back to where we need to be. We want to make sure that when we pull money out of our portfolios, we're looking at what impact that had on the portfolio, what changed, so that we make sure that we stay within what our plan dictates that we need. If you start receiving maybe a substantial amount of income If you're sitting on a 60/40 portfolio, but now distributions are no longer required, say for example, maybe you get a big amount of Social Security, maybe you retire a little bit early, but you delayed the Social Security benefits, and you have a gap in the middle that you need to fund. You've been taking distributions from your retirement account in order to pay for that, but now suddenly a nice amount of Social Security comes in and those distributions are no longer required. The present value of the benefit, so the idea of, if you think about sort of the financial calculators that we talked about before, if you think about sort of how much that income is spitting off, if you think of maybe, say, you've got a $50,000 a year benefit amount that's coming in every single year, and let's just say the bonds are paying roughly 5%. That $50,000 will be 5% of approximately $1 million. And so we can think of that as a big government bond position in our portfolio. So we can think of our brokerage account as a piece, and we can think of the value of that Social Security benefit as another piece, and they're really all one big part of the portfolio. So you may be able to take a substantially higher level of risk with that portfolio, assuming that we continue to believe that Social Security will maintain itself through the entire duration of your lifetime. But that can now serve as part of our bond allocation. So the objective of that investment account, if it's no longer needed for distributions, can shift towards a higher risk, more growthy sort of investment objective. Retiring earlier than expected can also have a pretty substantial impact. If you've got a 60/40 portfolio again, but you become disabled 10 years ahead of the planned retirement date and need to retire early, and Social Security is not covering the living expenses, and the portfolio was not large enough to suffer from a big equity loss and continue paying the income, we might now know that the portfolio is too risky. We might know that we need to step down to more of a current income, a lower risk portfolio, because we don't want that portfolio to drop a bunch in value, and then we take a bunch of money out of it, and then it can't recover back to the same level that we would need it to with a substantial equity market downturn. So we rebalance the portfolio to majority bonds and dividend paying equities to bring that standard deviation down. So now I want to go back and I want to recap on a bunch of stuff that we've learned all the way from the beginning of portfolio construction. So we're going to go through pretty much everything that we talked about when it comes to building portfolios. And if there are any questions on any of this process, now is the time we can pause and we can have good conversations about this. So remember the two things that we use for portfolio building: lateral integration, which is using time and objective-based allocations to manage your systematic risk, the level of market risk that you're taking on. Vertical integration, which is diversifying those allocations to mitigate unsystematic risk and tilt towards our preferred factors and sectors, whether you're a value investor or a tech investor or whatever that is for you. We're not necessarily aiming for the highest nominal returns, but we want the highest likelihood of success given the stated goals for our portfolio. A lot of people will, get it confused that they think if they're getting a higher return, that means that they're doing better. But you could be putting yourself in a situation where the risk of the portfolio is too high, and a downturn is going to greatly decrease the likelihood of success moving forward. So remember that an investment account can be part of an overall portfolio, and it can be evaluated on its own. How it fits into your overall picture is up to you. If you like considering real estate as part of your investment portfolio and like considering the risk of that asset class as part of everything, that can be a potential thing that you do. You might have rental real estate that is part of your income generation. You might have rental income coming in, and that provides for some of what would be the income generation in your portfolio, and you move more of it to equities. That's possible. You might like to look at it completely isolated and keep it separate from everything else and evaluate its risk all on its own. That's great too. So remember how we do things. We break things into our three stages: our short-term, our intermediate term, and our long-term investments. And then we've got our three levels of investment diversification, starting from low cost, broad-based index funds, moving up to sort of our tilts and our factor investing, and whether it's value or whatever else. and then moving up to our more concentrated or speculative or more expensive investments all the way up at the top in our smallest positions. Again, sort of represented in another visual way where each stage gets its own diversification benefits, and you can kind of remember how we did that when we built our own portfolio. And then, of course, calling back to our types of risk. These are the things that we're working with. Again, when we think of our lateral integration going across the time frames, that's when we're talking about systematic risk. And when we're looking sort of in this diversification aspect where we mostly try to acknowledge it with our base allocations, we're looking at unsystematic risk. This is the kind of thing that, again, we want to pretty much get rid of. If we have unsystematic risk in our portfolio, if we're looking at companies that have high levels of risk and we have high concentrations, we're not doing our best job at diversifying. Now, obviously, stock market indices are going to have high concentrations on their own. So it's important to understand where that baseline allocation is going to put you first. So if you're somebody who doesn't want to be as strongly concentrated in a position like NVIDIA, it's important to understand that as we do our broad market index investment, you're going to start out with a strong concentration immediately because it's the top stock in all of the indices. It's like 7% of the S&P. Immediately, that puts you at a high concentration. So if that's something you want to acknowledge and try and diversify away from, as we step up here, we want to use pieces and sectors of the market that put us in higher concentrations of other stocks. You might use something like consumer staples or value funds or dividend funds to give you a little bit of a pullback away from those technology-focused companies. That's why it's important to use something like this if that's a concern, to tilt away from those concentrations. And then obviously with our systematic risks, most of that comes to how much are we allocated to each type of investment asset class. When it comes to interest rate risk, that's pretty much purely a bond risk, where if interest rates rise or fall, the value of our bond investments and the distributions that they pay out can rise and fall. Market risk simply being that risk of being invested in the stock market in the first place that we can really only manage by reducing our stock market exposure. Exchange rate risk, which mostly comes from international investments or anything that has to do with any foreign country. Reinvestment rate risk, which really just comes down to when you have shorter term bond investments, the yield that those generate, the income that comes off, will change more quickly than that of a longer term bond. Because if you're sitting on a 30-year bond at 4.5% or 4% or 5% and rates start dropping to 3 or 2, you're going to be okay until that bond matures. But if you're sitting in a money market fund, the day that that rate changes, you're going to start seeing that yield to come back down. And then with our unsystematic risk, obviously, all the stuff that we want to diversify away from accounting and business, really just most of these are company specific, but things like country risk or default risk, we want to make sure that we're well diversified in our types of bonds and we're in decently high quality if that's a concern. And country risk, we want to make sure that we have some international exposure, make sure that we're not just 100% in the United States, because as we saw in April, there are potentially times where the US economy can have kind of a drag, but the international economies will help stabilize us a little bit. So that helps pull our risk profile back just slightly. So again, with our vertical integration, we're sort of thinking about total market low cost index funds or things that are just accomplishing our goal at a low cost. It doesn't always have to be an index fund. For example, with the fixed income, oftentimes I don't like using those bond aggregate funds because it just is a really weird risk profile to have every single bond just completely allocated from the shortest T-bills all the way to the longest US Treasury bonds. It just is kind of odd to have those all crammed into one investment. So I like to use either more sort of sectioned off intermediate term, short term, or managed bond funds for something like that. But when it comes to our equities, obviously we want to use those super low cost, super broad based, completely diversified funds to help us out. Then as we move up, we use our sector funds, our factor funds, and other passive funds that still are relatively inexpensive, but accomplish maybe a slightly different goal than something like a total market fund. And then we've got our managed funds all the way up at the top, possibly some more super concentrated funds, and maybe even speculative investments like in individual stocks. And then we got to building our portfolio. So again, this is just kind of like our super basic allocation guideline for a balanced portfolio. Remember that if you want to have a different risk tolerance, you just play with these numbers here. You just play with the stages until you get to a place that's comfortable for you. So if you wanted to be a little bit more aggressive, you might take 20%, you might reduce the stage 1 by half and go ahead and kick that over to stage 3 and tilt your risk a little bit higher. And if you don't even want to bother with the sort of volatility of this type of investment, you can pull it all the way back into the other stages and do something else. So again, it's just kind of a baseline example for how we might get to a balanced portfolio. So here's that portfolio that we ended up building, starting with our stage 1 investments with short-term bonds, really just short-term US Treasury bills. So Treasury bills here, short-term corporate bonds here, and then a little managed bond fund here. And then in stage 2, we had our balanced index fund, which is really nice because it gives you that sort of moderate exposure, but is very inexpensive. Minimal volatility stocks as well, and then a little bit of creative derivative income on top of that. And then overall in stage 3, this is where you see your standard S&P 500 fund, international exposure, and then a managed growth fund for fun, just to see if they have the possibility of doing anything extra. Now, before we get into our relative risk and return metrics, the more complicated stuff, we're going to take our 5 to 10 minute break. And then when we get back, we'll talk about beta, alpha, standard deviation, and stuff again to make sure that we understand those. So we'll take a few minutes and we'll be back and we'll get going. All right, well, let's get to talking about risk return metrics, our favorite part. So we'll start with the relative ones because these are some of the ones that are easy to understand because generally you'll compare them to something like the S&P 500. So when we're looking at something like beta, as we remember before, that's one of our measures of volatility or systematic or market risk of a security or a portfolio compared to a benchmark. Oftentimes, this beta will be against the S&P 500. So for example, we can actually look at what we just had pulled up, which is this dividend fund. We can look at the risk of this. So if we scroll down to this risk section here, you can see that over the last 5 years, it's had a beta of 0.77%, which gives us roughly 77% of the volatility of the S&P 500 with a standard deviation of about 13%, but we'll get into those in just a second. So you can see that, but then you can also, if you were to look at something like a bond fund, for example, this might be compared to a different index. So you can see here in orange, it's comparing it to the Bloomberg US aggregate, which is an aggregate index of all the bonds that are available. So if you look at the beta of this, you're going to see a similar number of 0.78. So that doesn't mean, obviously, that we're taking 78% of the volatility of the S&P 500 because we're comparing it to something else. So it's really important when you look at things like beta or alpha or R squared that we understand that they are relative to whatever it is you're comparing against. So if you're looking at Morningstar or anything of the sort and you're reading beta or alpha or anything like this, understand, try and find what it's comparing it to so you can better understand the level of risk that you're taking on with that investment. Yeah, exactly. Exactly. Yeah.
Is yield a number against that sum?
Right, exactly. So something like alpha, again, it's just if we take beta as our measurement of risk, we're looking at when we compare it to the benchmark, usually the S&P 500, how much excess return are we getting on top of the return of the benchmark? So if the S&P returns 10% and we return 15, some portion of that extra 5 is going to be attributed to what's alpha. So that's going to be part of our extra return. R squared is percentage of the fund or securities price movements that can be explained by the benchmark. So it's kind of a complicated one to understand, but really what it's saying is how different is the thing that you're looking at from what you're comparing it to. So if I'm comparing a stock fund to the S&P 500, if it's got a 50% R squared, then I know that its returns are likely going to be very different, and beta might not even be the right comparable level of risk. I might have to look at something else to compare to and use a different level of risk to sort of explain that volatility. So really, the best case for R squared is to tell you whether beta is useful in whether you're when you're comparing it to a benchmark. So if I'm comparing it to the S&P and the R squared is really low, that beta might not be super helpful. But then if I compare it to the bond aggregate and the R squared is really high, then beta is going to be much more useful to actually use. So that kind of determines whether that measurement becomes useful for us. Yes.
So, so I've been looking at different charts and have noticed, like, for example, certain investments may use different strategies to try and beat the S&P 500.
Sure.
They may short, they may put calls, whatever they need to do.
Yeah.
And I've noticed that some of them actually, I would say, have a fairly strong correlation with the S&P 500, that they kind of move in tandem. It makes sense. But I've also noticed that on market major fluctuations, like a major downturn, they may have to dump a lot of things to stay solvent. And therefore, you'll see the value of this thing. It'll be tracking the S&P just fine, and then it'll take this tumultuous drop, and then it'll continue to track the S&P maybe under it now.
Yeah.
So how does that play out when we're dealing with R squared? Does it still have the same R squared value, or does R squared somehow also account for the fact that the fund took a major stump?
Yeah, so that will likely reduce the R squared, depending on what time frame we're looking at. So if we're looking at a shorter time frame that includes sort of an event like that, R squared is gonna drop really hard, right? Because that loss can't quite be attributed to the market downturn. It's more attributed to whatever extra positions or leverage or whatever sort of derivatives they were using and whatever cash out they had to do. So that will absolutely affect it in the short term. But then if we're looking at the long term, if they track pretty close, then the R squared starts to creep up. So I guess it's one of those things where time becomes incredibly important when we're looking at all of these different things. So that can really affect all of the relative measurements. That's one really important thing. Again, if we look back to one of these funds, you can see that on here, I can choose different time frames for these risk measurements. So a 3-year beta or standard deviation may look a little bit different. You can see the beta here is 0.75 on the 3-year, but if I increase it to the 5-year, the beta, well, if it actually goes to the 5-year, that would be nice. Then it increases a little bit to 0.78. And if I change it to the 10-year, it'll be a little bit different as well. It decreases down to 0.68. So time becomes incredibly important in actually measuring these things, because the whole point is that we're looking back on that time period and using all of the available data to calculate these numbers. So if we shorten the time period by a lot and some big event happens, they're going to get thrown off in some kind of way. But if we really extend our time period and measure a whole bunch of other data that, supports a different theory, then that's going to be the thing that, comes out more.
Is there any guide of the number of years, or does it vary depending on the area that we're looking at?
Yeah, so it does depend on what we're looking at. So obviously, as we look here on this fund, for example, this is a bond fund. So if we only look back in the last 5 years, there's going to be some more of that downturn from the 2021 to 2022 period in bonds. That's why that beta is a little bit higher. But then if you add the next 5 years on the back of that, the risk profile comes down a little bit because they weren't so volatile before that. So it kind of depends. Usually I like to look at both a longer term and a shorter term and sort of use those as two things that I look at the same time. I like a 10-year. If I can get 10-year data on a fund, I like to look at that because a 10-year period is pretty significant. It doesn't contain all of the different events in the market, but it does give you a decent idea of how it performs over different time periods, unless it's just been a straight bull market for 10 years. But 10-year is one that I like to look at a lot, and 3-year is a good one, or even 1 year when it comes to like, if something happened recently, I like to look at, okay, so how did this end up comparing to the index in that time period? So it really just kind of depends on what you're trying to get out of it. Like, do you want to see the absolute long-term risk and return statistics, or do you want to see how it handled something in the short term? So that's kind of really how I would look at it. And so following those, we have our non-relative measurements. So these are things that are just kind of absolute. They don't require any benchmark to look at. These are just things that exist on their own based on the price data and dividends and all that kind of stuff. So we've got our mean return, which is just kind of our expected value of all of the different likely returns of investments comprising a portfolio, which really is just sort of like, what is the highest likely return based on all of the data that we've measured previously or over some, period of time? Because we then use that as the basis around which to measure our standard deviation. So if I have an expected return of 10% and I have a standard deviation of 10%, then that sort of variation around the mean return is really showing me what sort of returns I can likely expect. So standard deviation, again, really is just measuring. It says measures the dispersion of a data set relative to its mean, which really just means we're looking at that average return, that expected return, and we're looking at how far are we likely to go out from that roughly 68% of the time. So maybe the 2 out of 3 times, how far away from that average return are we looking to go? Obviously, different years or different periods can fall wildly out of that or be very close to the center. It really just depends. All of this is just looking at data and averaging it together. So things can be much different, but these are just sort of give us a general idea. Again, these are things that get based on time periods. So again, you'll see that things like annualized standard deviation will be here at different time periods. So it's going to be different depending on what you measure against. So again, as an example, if I look at the 3-year, we have a standard deviation of 5%. But if we look at all the time periods, put all of that data together, it increases by a little bit. And so the next one that we'll look at is Sharpe ratio, which is essentially just if you took alpha, but instead of comparing it to something, you were just looking at how much extra return did we get for the amount of risk that we're taking. So you're kind of looking at, yes, there's that average expected return that we're going to get, and then there's the return that we actually get. And so how much of that could be determined as excess given how much standard deviation there is. So if with all of that volatility, how much better did I do? How much more of that was sort of biased towards the upside rather than also towards the downside? So this can be a good measurement for just sort of standalone, how well did this perform for how much risk it took on, versus something like beta will be, how well did this perform compared to how much relative risk it took on to whatever we're comparing against. And then there's a couple extra ones that I like looking at now. Value at risk is nice because it kind of shows you how much of the value of the portfolio is at risk in any given time frame. So that might be 1 month, that might be 1 day, that might be 1 year, but it gives us sort of a time frame upon which there's some potential loss, and it gives us a confidence level. So those confidence levels will be represented by maybe 1% or 5%, which really just means 99% of the time we expect it to do this, or 95% of the time we expect it to do this. Yes.
I've been following those charts for 40 years. I've never seen that. Where did that come from?
So I'm not sure where it actually came from, but I noticed this not too long ago, maybe within maybe a year or two, I started seeing this a little bit more frequently, especially in my software Y charts. So
Y chart
yeah.
shows it, but Morningstar doesn't.
I have not seen it on Morningstar yet, no.
Okay, a
But
new one to me.
yeah, so you can see, blah, blah, blah. Let's see, I got to throw this one in here. So if I'm going to grab value at risk. So again, you'll see a lot of different options that we have to choose from. So there is the two that are represented here are daily and monthly value at risk. So a daily value at risk is going to be basically how much value of this investment is at risk per individual day. So how confident, if I choose daily value at risk 5% since inception, what we're saying is how much of this portfolio is at risk of loss per individual day about 95% of the time in our confidence level over the entire time period of the investment. So if we look at that, that number ends up being 0.36% because we have a very low volatility investment. This is something that usually goes, up or down from its mean return by 5% in an entire year. So those days are usually not very volatile. So each individual day is not going to be there's not going to be a ton of movement. There's not going to be a ton of variability. And you can sort of see that if we look at something like, let's look at the last 5 days chart. It's only moved by it's only been up by 0.3%. And at most it was up by 0.12%. So that's because it's a pretty low volatility investment. Yes.
Use in decision making.
Yeah, so this will kind of be used as, like if I'm looking at, say, if I want to have a fund that I know is going to be relatively conservative, standard deviation is helpful and all of that is great, but there's also sort of how much is it going to fluctuate on? It's really just kind of a different version of standard deviation. So it's just kind of another way to look at that with another frame of reference for maybe if I'm looking at a month period. So if I want to know that within a month, I'm probably not going to lose 7, 8, or 10%, but maybe 2 or 3 or 4, then I might move towards something that shows that for a monthly value at risk.
Be used to corroborate other decisions.
Yes, exactly. So it just kind of like matches up with standard deviation and beta. It's all just different ways of sort of framing the same information to just kind of give you a really good understanding of what sort of risk you're looking at for any given asset based on that time period. Yes.
Difference between the Sharpe ratio and difference between the Sharpe ratio and Sortino ratio, is that only the downside volatility for Sortino and Sharpe takes upside as well?
Yes, exactly. So Sharpe will look at both sides of the standard deviation. We'll look at both the upside volatility and the downside. Sortino is basically just somebody said, well, that doesn't make any sense because an investor is only concerned about downside risk. Upside risk is just return. That's just good stuff. That's us making money. So it's just essentially saying we're going to split that off and only measure the downside volatility and see how the return reflects against that. Because you could have, something that maybe had a period of really strong downturn, but also had really good upsides. And that might have a little bit different of a Sorrentino ratio versus something that doesn't fluctuate very much, but just trends upwards for a long time. So it's not going to have that same drag or that same drawdown, but it might have, so that might end up having a better Sorrentino ratio or something like that. So that basically explains the next one that I was going to talk about, which is Sorrentino ratio. So we'll move on to some bond related stuff. We have our average effective maturity, which is really just the weighted average of all the maturities of the bonds. When you've got 5-year bonds, 10-year bonds, 20-year bonds, 30-year bonds, all of that pulled together. And then if we have things like if you've got mortgage bonds, those can be prepaid. Somebody can prepay their mortgage and make the bond basically close out early, or companies can put a call function where if interest rates drop, they go, I don't want to pay you 6% anymore. Let me get that back, pay you a little bit for that so that they can reissue a new, cheaper bond. So taking all of that into account, adjustable coupons, all of the different ways that a bond could change, we sort of get that average effective maturity of actually how long is the average effective maturity of all of the bonds in that portfolio. And then if we factor in the interest rate, then we can get average effective duration. So if we have the average effective maturity, which is how long the average bond is in the portfolio, then if we also begin to factor in the interest rate, we can see just how sensitive a bond or a bond portfolio is likely to be to interest rates. So the idea is that if you have an effective duration of, say, 5 years, if interest rates drop by 1%, it's likely that the bond values will increase by roughly 5%. So it's really just kind of a multiplier of a 1% change in interest rates. So we can see how those can be a little bit different if we look at, well, okay, this is a good one for us to use anyway. So we've got effective duration here, and then I'm just going to swap out this yield for effective maturity. And then we can see those two numbers side by side and see how they can be different. So you can see here that you've got an effective maturity of almost 7 1/3 years, a little over 7 1/4 years, but the effective duration is only 5 years. So effective duration will be lower the higher the yield is. So if you were to compare something like a treasury bill and a high yield bond, if you have the same effective maturity, the high yield bond is going to have a lower duration because the interest rate is higher, making it less sensitive to interest rate changes. So you can see that the reason for that being is, something like a distribution yield, how much capital is actually coming out to the investor of 6%. If this number was much lower, the difference between effective duration and effective maturity would also be much lower. So we can see that in something like, let's just use, I don't know, we can even just use an aggregate. So we can see that the yield here is lower. And let me change this again. So let's go effective maturity. That's not how you spell that. There we go. So here you can see a similar thing. Again, you've got an effective maturity of over 8 years, but the effective duration is only almost 6 because of that yield that's factored in. And then the lower that yield goes, the less the duration is going to get reduced by that yield. Now, the next thing that we can look at is credit ratings. So looking at bonds, and this is normally we're looking at things like corporate bonds. It can also be applied to government bonds, but in the US, our investment analysts will always say that a US government bond is the absolute highest possible credit rating all the time, always. And you can even say for some reason that they're guaranteed because they're backed by the full faith and credit of the United States. But other governments might be rated lower by the same analysts. But we'll think about it more in terms of corporate bonds because it's just better to understand that way. It really is just a ratings agency like Moody's, S&P, or Fitch. They will look at the creditworthiness of a company or a government, and they will make a determination of how likely they think that company is to repay back their debt or other financial obligations. So you've got all of these different ratings, all the way from AAA to double A's and single A's, all of the different types of high grade, high quality investments, all the way down to bonds that are in default currently. So these are kind of all the different definitions that you could have. You could have your high grade with your double A's, double A plus, double A minus, triple A's, to upper medium grade, lower grade, and then sort of this line right here, everything above that is what we consider investment grade, which essentially just means it's of high quality, it's of low probability that anybody's going to default on those bonds. And then once you get below that, you get to what are called the junk bonds, which could also be more gently called high yield bonds. Now, these bonds will have to pay a much stronger interest rate to compensate for the fact that their creditworthiness isn't as strong. So if they're rated at a single B or a double B, it's going to have to be a higher interest rate than anything in those A categories because you're taking on extra risk by giving them the capital. So you have to be compensated for that. And we can see that in different types of bond funds, the same one that we're looking at here. We can look at the allocations and we can scroll down. So you can see different funds are going to have different sort of distributions to different bond credit ratings, but you can see that this fund likes to focus on really high quality. We're at 73.5% of our bonds are in the AA category, and pretty much everything else is triple B and above. They don't dabble in high yield. It's all investment grade. So that's what this bond aggregate fund will do. But then if we go to something like a high yield bond fund, we'll see a different story. So if we go into the allocations here and we drop down, you'll see pretty much exactly what you'd expect. You're going to see pretty much nothing in everything investment grade, barely over 0.5%. And then everything will be pretty much well allocated to the lower credit quality. So double Bs, single Bs, and below Bs. And because of that, you'll see that the yield of this will be decently higher. In the previous fund, the bond aggregate, we saw that the yield was around 4% or 4.5%. But then here we can see that the SEC yield, or pretty much looking at the last distribution that happened and then making that an annual number, is 6.5% almost. So you're getting much higher yield, but you're also taking on higher risk with those individual lenders. So it is something to consider. Now, again, to just sort of recap what we talked about earlier today, we have our two key terms that we want to use to determine any investment suitability. There are some other things that we consider. We do have objective and risk tolerance, but it's also important to consider things like complexity. If it's difficult for you to understand an investment, I usually think that that's not really a good fit, because if you can't understand how it works, you can't properly evaluate what type of risks it carries, what type of return profile it's going to have, and really just how it's going to fit into your picture. So if you need to keep things simple and you do index funds and maybe like some index bond funds or a managed bond fund, and that's it, great. If you just do index funds and T-bills, fine. If that's what you understand, good. If you have high conviction that you understand your assets and how they're working for you, I think that's better than being in a potentially better fund that does some more advanced things that you just can't wrap your head around, because you understand how it's going to work and what place it has and how much you should be allocated to it in the first place. So obviously, like we talked about earlier, our objective is our purpose for the funds invested. Usually we're describing what's in there. And I like to use objective separately for different investment accounts, because for me, that just creates a really good sort of mental picture of what goes in each place. So if I'm looking at my 401k, for example, that's going to be my growth objective. I don't need to really worry about the volatility in there. I'm just buying, what I think is going to be a good prospect in the future. But then if I look back over to something else, let's say I have an individual brokerage account where maybe I just want to get some yield. Maybe I put my emergency fund in there because I don't want to bother hopping between high yield savings accounts every time the yield drops. Maybe my objective there is going to be capital preservation, because that's where I'm going to be saving extra funds. So I like to divvy things up a little bit. I like to have some portfolios that are more conservative, some that are more aggressive, so that you can sort of have this overall picture. But it's easy to look at something, and if you have a big decline in your growth account, but you know that it's earmarked for that, you know that that's what it's supposed to do, then it's not really as much of a concern, versus you just have one big giant portfolio, and if for you that decline makes you scared and makes you want to change something, then that introduces a little bit of something that we need to address. And then of course we have our risk tolerance, which is pretty much, for me, I always like to think of this as the emotional component. People will talk about this in terms of risk that you're able to take, how you just answer a questionnaire, but that's where I really like to dig into what a person believes about risk, how a person feels about risk, just sort of generally, and how it impacts them. Because you might say a certain thing about risk, what you believe about risk, but then when it actually happens, it may be very different for you internally. I've seen that before. I've seen small market declines cause somebody to be very worried, versus somebody else can take a 30% hit and they go, great, where's the discounts? So, it's just sort of a different idea of how do you handle that risk? How do you feel about that risk? And how does it change what your next move is? So those are sort of the important things to consider. So with that, we've got a couple extra minutes, but that was a lot. There's a lot of information in all of that. It's jam-packed of lots of technical stuff and lots of things to think about. But are we sitting with any questions or any conversations that we want to have after that discussion? Yes.
Building of a portfolio. In the building of a portfolio, say a balanced portfolio with a risk management. So it seems to me like it's a combination of what's the objective,
Yes.
and the risk management. The question is, are there all this risk management within the different objectives? So-
Absolutely. I would say yes, because you can have sort of balanced investors can be 50-50, they can be 60-40, they could be 40-60, or you could be 60-40 and one of them could like tech stocks and one of them could like value stocks. One of them could like treasury bills, one of them could like high yield bonds. So there's all of this different variability that goes into it. So that's kind of one of the things that I like to look at. So like for me, if I'm looking at my investment accounts, like I'm willing to shy away from value companies because I don't need them to have big moats. I can go for growth companies that might have tons of volatility. I can go towards bonds that have lower credit quality because that higher yield may be worth it to me in the long term. It's possible. But then you might look at another investor who's just like me, but they like value stocks, and that's going to bring their risk profile down a little bit. Or they might just not want quite that same level of variability of returns. So it absolutely, within each of those things, that's sort of when we get to when you're choosing each of the different, stages and layers of diversification, choosing each of the individual positions starts to get into that conversation. Because you could be a balanced or current income with a slightly higher or a slightly lower risk tolerance, and that's going to help clue you into what different things go in each different stage. Like stage 2 could be more equity focused, or it could be more bond focused. That's going to change the risk level of your account. People that like more corporate bonds in there, or they like those balance funds that we showed, or maybe they just want value stocks. So really, absolutely, tons of variability, tons of places to play, and lots of little changes that can make a difference in the portfolio.
You mentioned the word moat. What's that mean?
So that is basically looking at companies that are really well cemented in an economy. So you can think of things like Pepsi, Coca-Cola, big companies that they're not going to get kicked out of their place. It's just probably not going to happen. That's one of the things that Warren Buffett likes a lot with his investing. He likes to buy companies like that have big moats that are going to stay around. So that's pretty much what that is referring to. Anything else? Okay, well, we've got a couple extra minutes, but I think that's a totally fine place to wrap up. Thanks everybody for coming again, and I hope that this has been helpful. And if you got any questions, we hang out for a while. You can always shoot me an email if you've got anything or you want me to cover anything. But thank you all for coming very much. I appreciate it a lot.